Are you looking to invest in the Perth property market and want to use a local buyer's agent to help you secure your next investment? Mitch and Sam are the co-founders of SJR Property Group, a buyer's agency based in Perth that specialise in helping investors build property portfolios that outperform the market. Check out www.sjrpropertygroup.com.au to book in a free discovery call and chat with a local buyer's agent today.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, g'day, how you going? It's Phil Tarrant here. I'm the host of the Smart Property Investment Show. We're back for another installment of this podcast where we're now getting sort of upwards of a couple of 100,000 people tuning into it every single month. So we've been doing it for a while. We're about to hit a massive milestone in a number of podcasts we have recorded. This is very much one of the very early podcasts around property and property investment. Now there just seems to be everyone launches a property podcast or write a passage. There's many property podcasts as there are a website these days, but it's nice to know that people rely on the information, the correspondence, the insights, the interpretation of property markets that we host on the Smart Property Investment Show to make more informed buying decisions. As you all know, I'm not a property professional. I am a journalist. I am a property investor myself, and I've had great satisfaction sort of sharing my journey, the narrative of investing in property over many years now on this podcast, and it seems to resonate. Hence the reason why a lot of people sort of share this and tune into it. And the biggest negative commentary I get on this is that people wish I did it daily. Well, I can't do it daily. I could probably do it daily, and there's enough information out there, but takes quite a lot of time to do it. But anyway, that's time for another conversation, another point in time. I like bringing people into the show who have a different lens, view property through a different lens, and interpret what's going on in the market, particularly markets in flux, which we certainly are right now. We're recording this. I don't like time-stamping podcasts, but we're recording this on the day of the RBA rate announcement, which we've all been waiting for. We know now that the rate at which we're doing and the RBA's meeting has changed effective this year, 2-day meetings rather than 1-day meetings, and they're not going to be making rate announcements as frequent as what they used to, which used to be 11 times a year. Now it's back to 8. So hopefully that should slow rate rises down. And I think we're pretty much at the top of the cycle. It's just whether or not rates are going to start coming down and when. We're going to have a conversation around that today, as well as a lot of dynamics and interesting dynamics in the property market, which might not be visible to a lot of people. And I received a press release recently, and it really captured my attention because it reaffirmed something I thought. However, it was very hard to find this information. That is a number of Australians who are actually buying property with cash money, i.e. there's no debt, there's no mortgage. There is this assumption, if you follow the press, that all Australians have mortgages and all Australians are struggling to make their mortgage repayments. Well, let me give you a hot tip. There's a big cohort of Australians that don't have mortgages, and they're actually benefiting from higher inflationary cycles, increased money in term deposits, and the fact that they don't have mortgages. The headline is 28% of buyers across the eastern seaboard of Australia bought property last year with cash. Joining me in the studio, Julie Toth. She's the chief economist at PEXA. I'm going to ask her all about this. Julie, how you going? You well?
Hello, Phil.
It's good to see you. Now, before we kick off, most of our listeners who have purchased property probably know about PEXA. So let's just sort of sort the bona fides out of what PEXA is and does. Maybe it can help shape our discussion. Who is PEXA and what do they do?
Yes, certainly. PEXA is Property Exchange Australia. It's the digital platform that looks after all property transactions, mortgage transactions, refinancing across the Australian mainland states. I'd like to say we're completely national, but we haven't got Tasmania on board yet, and we are expanding into the UK. So if you're buying any property in Australia and increasingly in the UK, your transaction will go through the PEXA platform. It matches up all the buyers and sellers, gets the information where it needs to go, and more importantly, gets the money to the right institution at the right time.
So essentially, it's like a black box where all this information at the point of sale of the property at settlement goes in there, gets shaken up, everyone gets paid appropriately, the money goes to the right institutions, the vendor gets paid, the bank gets paid, any other creditors get paid, and the whatever's left ends up in the hands of the right people. That's what PEXA does?
Correct. It's the best way to describe it as a property version of the ASX, which you'd all be familiar with for stock exchange purposes. And like the ASX, it's not something that you would be dealing with directly as a buyer or seller, but certainly your legal representatives, the banks, the conveyancers, they're all in there and making sure the transactions run smoothly.
Well, what I understand also, it's pretty well regarded globally. Australia is pretty far advanced in relation to property settlements and transactions, clearinghouses for property. It's still very antiquated and cumbersome in other Western places, Western countries.
Correct. And it is at a state level too. PEXA is an interesting beast. It was actually set up initially by the banks and the Australian state governments as a way of digitising conveyancing and bringing it into the modern economy. But as you'd all be aware, that there's still significant legal and cost differences across states. So it is complex.
Well, thanks for making it a lot less complicated. I remember trying to do property transactions before PEXA really found its feet, and it was not as easy as what it is today. So, simplicity and streamline, it probably helps at that settlement point of view. For a lot of people, if they don't do a lot of property transactions, it's a pretty stressful time as well. So it's good to know that PEXA is doing what it's doing. Now, so what does the chief economist at PEXA do? Tell me about your day, Julie.
My day involves looking at a lot of property data, a lot of demographics, and actually on the regulatory side, looking at the changes and the regulatory arrangements across states and internationally. So I do spend a fair bit of time looking at the data that comes out of PEXA. A key feature, for example, is actually better security. So, you don't have money flowing through conveyances with cash or with checks anymore. It is all done digitally. So one of the things that we were going to talk about today, Phil, is what we've loosely dubbed cash purchases. But just to be clear, there aren't any purchases for property being done literally with bags of cash in Australia. It is all done electronically, which is far more secure.
It's far more secure, and it's a lot easier for the government to map and monitor financial transactions, particularly significant financial transactions. Yeah, good luck even going to a bank these days and trying to take $5,000 out, selling it possible.
Yeah, that's right. They've always been monitored. We've got the land titles officers in each state. We've got the RBA, AUSTRAC, ASIC, others monitoring the financial institutions. So there is a lot of monitoring going on already. This is just centralising the transaction process.
Yeah, and it's also it's rich pickings for cyber criminals, real estate transactions. And there is still a lot of fraud in and around real estate transactions. So, digitising it is key, and to have that security. But the mind boggles still how many times people at a point of settlement are moving money into fraudulent bank accounts and getting their deposits stolen. It still happens. So no doubt that's a big thrust and focus for PEXA, is to put greater resilience into real estate transactions process to try and protect Australians from that.
Yeah, that's right. It's a huge issue because the amounts of money involved are just so large. They're much larger than a typical ASX transaction, for example.
How often do lawyers still fiddle the books when it comes to trust accounts or conveyances? They still dipping in there and using it as emergency funds? There must be a lot more sort of...
I don't think I can comment on that.
Anyway, I'll do my own investigation around it. No, but it does happen. I know it happens inside of real estate rental transactions where money sits in trust accounts, and there's a lot of really good new technology. I've spoken about it in relation to that. Now, Julie, let's chat about cash buy. So this isn't someone walking down the street with a duffel bag full of cash. This is people who are buying property without a mortgage. We'll get stuck into it. We're just going to go to a break, everyone. Stay with us. We'll get through that when we come back. Back in a moment.
Are you looking to invest for a big return, but are unsure which suburb is up and coming and guaranteed to give you the most bang for your buck? Smart Property Investment and Pure Property Investment have unveiled the Fast 50 report for 2025, identifying the suburbs backed by research that are giving investors the highest returns. Don't make any investing decisions until you read the free report. Visit smartpropertyinvestment.com.au to download the report.
Welcome back. It's Phil Tarrant. I'm the host of the Smart Property Investment Show, chatting with the chief economist over at PEXA, which is the property exchange for settlements of real estate transactions in Australia, Julie Toth. Now, Julie, the headline number was 28.5% of all residential property sales in 2023 across the nation's seaboard eastern states, which is Victoria, New South Wales and Queensland, were cash buyers, i.e. bought without a mortgage. That's up 1.5% on the year prior. So the total value of those transactions in cash was 129.6 billion bucks, up from 127.7 billion bucks a year prior. That's a big number.
It is, Phil, and I think it has caught a lot of people by surprise. It has gone up in 2023, as you say. So we've got these data going back to just the end of 2019, no earlier, unfortunately. But for 4 years there, it was sitting at around 25% of residential purchases being conducted without a mortgage required to complete the purchase. So that's what we mean by a cash purchase. And it did go up to just over 28% in 2023. Now, just to set the scene for that, it does still mean that the majority of buyers need a mortgage, whether they're investors or owner-occupiers. But this is a big cohort. So, a quarter, in some years more, of purchases in that residential market are being bought without a mortgage. And there's a variety of reasons for that. But if you think about the structure of our housing market and, household formation, we know from the census that about roughly a third of households are in fact owner-occupiers without a mortgage. Roughly another third have a mortgage, and then the remaining third are renters. So that's the approximate composition. It changes around a bit, and over time we know that the group with mortgages has actually increased as it's become harder to achieve that mortgage-free status. So what we're seeing with this group of buyers is it is largely reflecting trades by and between that group of mortgage-free households. And we can see that in the locations, in the types of purchases that are being made, and, extrapolating that to the demographics of the buyers and sellers.
Yeah, so we'll get into where this cohort are buying, but you've just said something that triggered my interest, and that is, people sort of bandy around these terms of a third of Australians live in their place debt-free, a third have a mortgage, and a third rent. So the third that rent means that they're in investment property. So I'd like to get a bearing on
correct.
Mortgages around that. So on that basis then, so these cash buyers in the market, do you have any delineation between whether they're used for investment purposes or whether they're used to live in owner-occupiers?
Yeah, that's a really good question. And it can be a little bit fluid there. For example, someone might buy a property and rent it out for a couple of years and then move into it themselves or vice versa. So we don't have visibility of the purpose of the purchase at the time, because unlike, when you take out a mortgage, you have to say what the purpose is, right? You need to say whether it's for investment or for owner-occupied. And that's true for tax purposes as well. But of course, if you don't have a mortgage, that information isn't required and we don't collect it. But we can see where the properties are and the demographic profile of that area and, extrapolate from that the likely scenario for the purchase.
Yeah, you'd need to use the assumption, if you look at sort of the immediacy of annualised transaction, if a quarter of them are cash buyers, that means 3/4 have some sort of debt connected with it. And if a third of Australians rent, you would have to assume that most properties purchased for the purpose of investment do have debt connected with them. So that means be 2/3 of those properties of Australians that people renters or live in have mortgages connected with it. It's hard to get this information, even the information that you've got here today, Julie, which is how many actually just cash buyers. This has been really an invisible number for many years. Thanks for sort of scratching the surface and finding this out, because it's been this big question mark a lot of people have been asking about for years.
It has. And I think the digitisation of the transactions really helps us get better detail and better real-time information on what's going on out there. I think, Phil, we've identified sort of two main groups that are involved in buying purchases without a mortgage. So it might be helpful if I talk through the two groups.
Absolutely.
They're quite distinct. So the first group, which is actually the larger group, is generally older, and I say generally because it is very much a generalisation, older households that are already debt-free or perhaps are able to draw on income from other sources. So, for example, they might have other savings or investments or superannuation that they can draw on to make the purchase. And they are generally buying in areas that we loosely call the sea change, tree change locations. So particularly prominent, for example, Queensland coastal areas, regional areas of northern coast New South Wales, a few spots around Victoria, but not as many. And it's really that sort of life cycle story of people moving out of urban areas into the regions. They're often moving to a lower cost location. So, that also helps with not requiring a mortgage because the price points for these locations are generally lower than average. There's a few exceptions though, like for example, Surfers Paradise, the Gold Coast, Broadbeach, properties are still fairly pricey there. So you don't see too much change out of moving from Brisbane or Sydney, for example. But certainly if you're going to Caloundra or Hervey Bay or somewhere that's cheaper, that helps as well. So quite big movements to those sea change areas. The second group, which is more interesting from an investor perspective, is quite large numbers and proportions of dwellings in the inner city of Melbourne, Sydney, and to a lesser extent Brisbane that being transacted without a mortgage attached to the sale. So, for example, Melbourne 3000 postcode, which is mainly apartments, we know that about 3/4 of households in that postcode are renters. So that's your investment pool. We also know now that about half of those properties are being bought without a mortgage attached to them. So that's telling us that the investors in that suburb, in that postcode, are either raising their finances through other means. They don't need to take out a mortgage. They're using other finance vehicles, or they may be raising money offshore, particularly if they're international investors. They're not using the Australian mortgage market to make that purchase. And we can see that across Sydney CBD shows a similar pattern, not as extreme as Melbourne. And the same for some of the inner suburbs, places like Carlton or, Glebe, even some of the more expensive suburbs. Mosman came up, and even Brighton and Toorak in Melbourne. So it's places that they're not necessarily cheap, but they are very much favoured by investors because of the high rental demand and that rental profile.
Yeah, lots there in as many different ways we can sort of unpack that. I would say that, and I'm curious, the 3000 postcode and even, similar postcodes in Brisbane and in Sydney for cash buyers, particularly on apartments, new build apartments or probably newish build apartments. Do you capture the nationality of the buyers who are transacting these properties? And there I'm assuming in Melbourne in particular that you would have a lot of offshore, mainly Chinese money going into those areas, paying with cash. Do you have any sort of bearing on that?
So we can't see that directly. Technically, we can, but we're not allowed to.
You're not disclose it. Yeah, I do think so.
Yeah, there's a lot of regulatory limitations on the data that we're still getting to grips with, and it can be a little bit frustrating because they're exactly the questions that we want to be able to answer. And actually, all of that is recorded because the state governments need it for tax and revenue purposes.
Yes,
because
true.
those buyers do pay different rates. So all of that is
they do. They'd all be getting surcharges on their land tax, for example, if they are foreign buyers. And I'm curious, not on the basis of who the foreign nationals who are buying this property is, the impact on property markets as a result of it. And if you bring that back to that first cohort of buyers, which are sort of sea change, tree change people, and they might be selling a home in a capital city and realising a healthy return, and they may be buying themselves a place in the northern coastal areas of New South Wales and also buying an investment property for the purpose of investment. Who knows?
They could be, that's right.
Yes.
So on the international buyers, Phil, there's some other data sources that we can look at. For example, the Foreign Investment Review Board does publish annually numbers on foreign buyers in the residential property market, and it is lower than many people think, probably because it's so concentrated. So the areas where it does happen, it's quite visible. There's also legal limitations on international buyers, so they do need to buy a new property. Special permission required for existing homes. So that's one of the reasons why they're not so visible or active in regional markets, for example. The NAB publishes some interesting detail in their residential data where they actually ask agents about nationality. That's indicating that nationally it's probably only 1% to 2% of the property market involves an international buyer. But when you look at new builds in the inner city, it jumps up to sort of 15 to 20%, depending on the location. So they are very concentrated and very active in these inner city markets.
Yeah, and it's largely relevant who the foreign national is buying. And I know a lot of people get caught up in that. And it's, not representative of the wholesale big significant chunk of the property markets. However, what it does if you sort of drill down to at a suburb level, if you've got 15 to 20% of, for example, buyers in a particular postcode who are foreign, that's going to have certain dynamics and impactful dynamics on the property market, which will also have impacts on lenders' willingness to potentially lend money in and around real estate in those particular areas. I know a lot of lenders will have postcode restrictions on certain areas if they do not have confidence or they think certain markets are overheated, overcooked, overdeveloped, all this sort of stuff. So it does matter as you're making property investment decisions. And that even also applies to the sea change and the tree changes. If they're entering markets with cash in, let's call them more lifestyle, holiday orientated areas, which were probably hugely popular over COVID.
And that's exactly where they're still buying, Phil. So even after COVID, when we look at the property sales patterns for 2023, COVID's well and truly over. We are still seeing that same pattern, exactly what you're saying.
So they're buoying. They continue to put positive pressure on prices inside of these more holiday or lifestyle orientated areas, which are in their own rights, some large diversified economic base. Basically, I'm thinking Coffs Harbour or the Northern Rivers area or the Byron Bay area or,
Correct. And
your
that's
Tweeds
exactly
and et
where we
cetera.
see this. Yeah.
And how much heat are they actually putting into the market? Because cash buyers will often be maybe a little bit more emotional in their decision making if they're buying a home to, inverted commas, retire into, when you still have a lot of property investors active in these regional markets, attracted to them for the returns that they're getting. It must be a really tough one to unpack.
Yeah, the pricing story is quite complex because these areas have had significant price rises. We haven't seen much of a drop. Certainly, there was a bit of a drop early in 2023 in response to rate rises, a bit of a new circumstance for many buyers just because it hasn't happened for so long. But the market recovered remarkably quickly, really, when you think about we were still getting interest rate rises up until November last year, and yet pricing and sales activity volumes both began to recover from about March. So we had really unusual circumstance where we actually had prices and sales volumes going up at the same time that interest rates were going up. And that really speaks to the strength of underlying demand in the market and the confidence that people generally had in the outlook for the market despite those rate rises. So it was an unusual circumstance.
So this is where I become sort of a bleeding heart property investor, and I've got to highlight the fact that a lot of attention, both at a government level but also at a societal level, is towards the impact of property investment towards housing affordability. As a journalist, the headline for me is that cash buyers are probably more responsible for driving up prices in property than what potentially property investors are. That's a big, bold claim, but it doesn't get the headlines, does it?
Well, the groups overlap. And look, there's so much to unpack with housing affordability at the moment. There's short-term impacts from COVID, from this huge surge of net migration that we've seen in 2023. Remember, at the same time, we've had over 500,000 people arrive in the country in 1 year. So that's sort of more than 2 to 3 years worth of net migration all arriving at once. And, all of these things are colliding together. The longer term trends, I think they're more complex than just supply and demand. We also have some fairly important socioeconomic trends that playing a role. So, for example, declining household size. So that is, in lay terms, just the number of people in each house. That's been in long-term decline. It fell quite significantly during COVID as people spread out, and it hasn't reversed. So, the RBA estimated that alone added well over 100,000 homes to the demand side of the equation during COVID, and it hasn't reversed. Another one is the size of homes. And again, COVID exacerbated that. People working from home want extra space. People that are moving into a retirement phase earlier in life, they're going to be spending more time at home. It's not necessarily the case that people want to downsize. They actually often want more space for their hobbies and their activities when they move out of the workforce. So it's quite complicated unpicking all these things, but all of them are adding to demand pressures. They're not helping with supply, but they're all happening at once.
Certainly shifting sands. And in some ways, your retirees in Australia, political forces are quite careful around alienating too much. In some ways, they're sort of largely protected species that every now and then there's some questions asked around sort of superannuation savings and taxing that. I know the government now is taking a lot more focus on this view towards tax minimised strategies using trusts rather than people using them for the purpose of estate planning. I'd like to know how many of these buyers actually buying are in their own names in cash versus buying them inside of trust for the purpose of some sort of longer term generational wealth creating. I don't know if you pick that up. There is 1,000 different questions you can get from this.
So this is about, so we've counted the number of transactions rather than the number of buyers involved. So a trust sort of counts as one person for transaction purposes, if that makes sense.
Yeah. And you don't capture it or you can't disclose it?
Well, again, it's the regulatory conditions around the data. We do need to keep that confidential.
Yeah, see, I'm hugely curious about that.
Me too.
It's because I think when you look at this idea around housing affordability, if you've got this driver, and in many ways they sort of cashed up retirees, if you want to call them that, for the use of a better term, have had all the benefits of better cash returns if they keep their money in cash or cash alternatives. As interest rates are going up, they've all had the benefits of, if they've held property through the period of time from pre-COVID to post-COVID, significant increases in equity in their portfolio. This is a big cashed up cohort, and in many ways, driving property markets and the inherent resilience of property markets in Australia, which you alluded to inside of your press release that you put together here.
Yeah, that's right. There's pros and cons to this. Yeah, so there are definitely sort of intergenerational equity considerations that do get a lot of attention. But I think it's important to remember that we need some stability in financial markets and property markets. We don't want huge volatility in prices. That's not good for anyone. So, this cohort is providing the stable base, the resilience that we need.
And it's well put, Julia, because when you think of the inherent strength of Australian real estate markets, which when global people look at our market, they go, it's a big bubble and something's going to burst. The reason why is that if you've got a quarter of all real estate transactions in these areas, but let's just assume it's statewide, a quarter of all real estate transactions are paid for in cash, and the other real estate transactions having a mortgage connected with them. And we have some of the strongest, most robust and resilient banks in the world that operate under the apparatus of prudential regulation through APRA. This means to me as a property investor, the inherent strength of this as an asset class. And we spoke before we come on air, property is a national pastime. Property speculation is a national pastime for all Australians. And this is therefore the attractiveness of real estate, because you've got these two forces, bank funded lending and cash lending under the apparatus of regulation, which is connected with a government, which is supportive of property investment in Australia through the way it structures tax incentives around it, because the government doesn't want to be a landlord. They want Australians to be landlords and be the provider of housing for the third of those Australians that do rent. You must have fun every day pulling these things apart, Julie.
It is interesting, and it's definitely a big puzzle. On the investor side, I think you're right that the regulatory tax arrangements, financial arrangements are very supportive of property over other forms of investment. But the other thing that keeps the market strong is just the sheer strength of genuine demand. It is not speculative. We have record low vacancy rates across the country. We've got high population growth, particularly in inner urban areas. We just don't have a large pool of speculative housing development. That's not really part of the market like you see in some other countries where bubbles did form. So, for example, if you look at the US prior to the GFC or Ireland soon after, there were property developments in both those countries that were largely unsold and uninhabited. And we just don't see that type of development and activity in Australia. It is genuinely demanded.
Yeah, it is. One of the consequences of the environment we operate within right now is the problem around building starts. I want to have a chat around that, because this inherent supply and demand equation is where it is. And I'd like some views towards what you think is going to happen in the budget. We'll just go to another break. Stay with us, everyone. Back in a moment.
G'day listeners, Sammy Gordon here from Australian Property Scout. If you're loving all the property investment content over here at SPI, you will love the Scouting Australia podcast. Hosted by myself alongside my good mate and experienced investor Jimmy Ibrahim, we unpack everything from real investor stories, mindset hacks, and a massive amount of property investment strategies and much, much more. Check us out over at the Scouting Australia podcast and take your investing to a new level.
Welcome back, Phil Tarrant from Smart Property Investment, having a chat with Julie Toth over at PEXA, the Chief Economist there. Now, be remiss of me not to ask you around some of these complexities and challenges in relation to real estate transactions in Australia. And I think we've sort of both find a flag for real estate as an attractive asset class because of the fundamental strengths of it. That said, I noticed in today's paper, the state government here in New South Wales complaining about getting ripped off on GST receipts, particularly when they seem to be sort of carrying the can when it comes to migration. They want their fair share of the dough that's getting handed around. But the big issue I see, Julie, and I don't know whether we're going to resolve it, under this current government or any immediate current or future government, that is around how do we build more property in Australia to alleviate some of the challenges around housing affordability, with an eye towards what we all want is the consistent ongoing growth and inherent growth and strength of Australian real estate markets. It's way outside my pay grade. I think it's outside the pay grade of most people because we don't seem to be making the right decisions right now. But do you think we're going to see anything in the budget coming up in May around sort of trying to tackle, inverted commas, housing affordability? And I do know, and I've been very vocal about this, messing around with building 40,000 new properties over 3 years through a shared investment scheme doesn't even move the needle on where we need to be.
We saw quite a few measures last year, and I think there'll be more this year. That's announcements. It takes a lot longer to get things through Parliament and get them up and running. One of the bigger measures last year was the sizable increase in rent assistance for those that qualify. We could see that type of measure again because that does directly help with affordability for those that are really struggling to find anything that they can afford in the private rental market. The longer term goals about increasing supply are just that. They're long-term goals. The government has already increased its target from 1 million new homes to 1.2 million new homes over the next 5 years. And as you say, 40,000 is a drop in the ocean if your target's 1.2 million. I've been having a look at the data for nationally for housing stock, dwelling numbers across Australia. And if you look at the growth in those numbers over the long term, 1.2 million over 5 years, that sort of implies around 600 over 2 years, and bringing it back to annual and then quarter numbers, you can look at whether we've ever achieved any sort of growth that might help us get there. And the only period where we got anywhere close, but even then not sufficient, was during 2015, 2016, when we had that apartment building boom in the inner cities. The number of dwellings being added did jump quite significantly, but it still wasn't really enough to get you to 1.2 million over such a short period. But that tells me that if we were going to get there, the focus needs to be on multi-dwelling apartments, high density, rather than greenfields. They're just too slow and too resource intensive to get to that kind of growth with the standard sort of house and land suburban model.
And therein lies the big challenge, because there's still this romantic view for a lot of Australians of a house in a suburbs with 5 bedrooms and a block of land with a picket fence, right? And there is a cohort of Australians now who are quite comfortable and attracted to apartment living, but there's a big cohort that still want the house in the burbs, the great Australian dream. And I don't know how they're going to do it over 5 years. I can't see it. Developers don't want to develop right now. There's not enough dough in it. There's still a lot of challenges around labour and material. It's not going to get any cheaper. So something mechanically needs to happen around that. And I just can't see it happening unless something drastically changes in terms of the decision-making at all levels of government, whether it's federal, state or local. It would need to be a whole-of-nation concerted effort to get towards even close to those numbers.
And putting on my old sort of labour market economics research hat, I would observe that land zoning and issues like that is only going to get you so far when it's patently obvious that the industry is already at full capacity. There just aren't any unemployed builders, tradespeople, skilled engineers that you need to build on this kind of scale. And the capacity that is there is also being directed to major infrastructure projects across the country. So that's transport projects, telecoms, mining, industrial. They all use the same sort of skills and the same sort of labour. So construction's important. It's around 10% of the workforce and output, which is fairly typical for an advanced economy. But Australia's already at capacity with our 10%. So unless we can move workers and move resources from other activities into construction, no amount of rezoning is really going to help get that pipeline moving faster.
Just sounds like we're buggered, really. Like,
I think maybe we just need to slow down and take a bit of a breath and look at the housing resources that we've already got, and can we use them more efficiently, more effectively? I know we do need to increase supply, that's true, but we also need to think about, what type of supply and who is it for? And this is where you get into the demographic detail of population growth and population forecasts. If the growth is all coming from international students, for example, which is what's happened over the last 2 years, they don't need a 5-bedroom house in the suburbs. They need a bedsit in the city. We need to look at
it's a good point.
What we're building and who is it for.
I saw recently there was a development which was oversubscribed by 2 times or even more, which were 20 square metre apartments, i.e. bedsits, which were, very smartly designed, compact dwellings. And that is a dwelling. And if we don't have these, the family formations are getting smaller. You do have some generational families living together who are attracted to a particular type of housing. But if more people want to live by themselves, they don't need a 4-bedroom house, right? So it's a mindset shift. It's an attitudinal shift. But it's got to be the money available, and it's got to be attractive enough for property developers to actually take on these projects, knowing that they're going to get at least some sense of continuity decision-making from the governments. We're talking about 4-year terms for governments moving forward. I think that's a good thing. That should help with a lot of things. But Julie, we're not going to solve any of this today. I think we just pose more problems.
It's great to talk about it in the context of property investment because, as well as I said, as well as thinking about, how many properties you might invest in, it's also about what type and where they're located. Because remember that in addition to 1.2 million, the Housing Accord also stipulates that all of these new homes should be well located. So it does come back to location as always, and that's where the demand will be.
So are you advocating then property is an asset class worth investing in then, Julie?
Always.
Well, it's good. It's a nice way to bookend discussion. I've enjoyed catching up, Julie. We should do it a little bit more frequently. I like chatting with economists just to try and unpack what's going on. And if I was to try and describe this current market, I would say it's certainly in flux. There is so many moving parts and still so much uncertainty. So hopefully the people in power can get the right decisions made at the right time to ensure we do increase supply of property in Australia. But that said, I think there's still inherent strength in our markets and the continue to be over time, including, the settlement of properties through PEXA. So I hope you guys continue to keep advancing that platform. I know you're always releasing new ways of doing things.
We will. Thanks, Phil.
Nice one. Thanks, Julie. I hope you enjoyed that, everyone. Lots to talk through and work through there. Any questions at all? If anything, just you sit and go, I don't even know what you mean by that. Contact the team, editor at smartpropertyinvestment.com.au. You can go and check out PEXA. They're just pexa.com.au. If you don't know about them, if you're buying a property, no doubt your conveyance will introduce you to it at some point in time. Remember, Smart Property can be found, Smart Property Investment on Instagram or Smart Property HQ or everywhere else. Go and check it out. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finny. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finny mortgage specialist on 02 8866 2444 or visit our website at www.finny.com.au.